Hi, you're watching Investor Insights, and in this video I'd like to talk a little bit about the concept of return on equity. Sometimes people call it R.O.E. Now, if two companies listed on the stock market and company A had an IPO of say $10 million and company B had an IPO of $50 million. So the first company had to raise $10 million either to start up or whatever, and company B had to get $50 million. Now, both companies generate $5 million within their first year of operation. Now, the return on equity for company A, which raised $10 million, has basically made $5 million using that $10 million. So the return on equity is basically 50%, 5 million out of 10 million. Company B raised 50 million and made the same amount, so 5 million. Therefore, its return on equity is only 10%. Now, on paper, both companies made the same amount of money. But technically, if you look at the return on equity, it's telling you a very different picture. Because company A is basically 5 times more efficient in using its capital to generate money than company B. This is a technical number, and sometimes there's a lot of factors which can affect it. I'm not going to dwell too much into those. But let's just say that companies with high return on equity ratios are very efficient in generating profits from their initial equity rather than companies that have low ratios. And efficiency counts, because efficiency means basically when you do something, you're very good at doing it and generating a profit out of it.